Welcome to the Series 7 Top-Off Exam audio lessons. This is lesson number 49. In this lesson, we're going to be talking about partnerships, also called direct participation programs. In this lesson, we're going to be talking about limited partnerships. Pretty much every year when my clients get their K-1s from their master limited partnerships, they call me up and are very frustrated with it. And I've had clients in the past tell me that, hey, get rid of these damn things. I don't like getting the K-1s every year, and I understand it. It's a frustrating issue to deal with K-1 reports. K-1 reports are the information reports set out by partnerships and also small private businesses such as subchapter S corporations and other entities. But nonetheless, a K-1 report is required from a partnership to its partners. Now, in the case of what I call master limited partnerships, and it's commonly called master limited partnerships, these are, for the most part, publicly traded limited partnerships. We're not going to go too much into the master limited partnerships, but I just want to discuss what the issue is with the K-1 reports. The main problem that my clients have with K-1 reports is that it requires their accountant to fill out a special form, or if they're doing their taxes themselves, it requires them to fill out possibly different schedules on their personal tax returns. That's not the biggest issue. The biggest issue seems to be that the master limited partnerships or the limited partnerships aren't required to get out their K-1 reports as quickly as corporations are required to send out their dividend reports, their 1099B reports or 1099D reports. I think it's 1099B. Regardless, whenever you get a statement from your broker about what dividends you receive for the year, you get that in a timely manner, in plenty of time to file your tax return by April 15th. That's not the case with K-1 reports. With K-1 reports, they may come in on April 15th themselves. So you're almost always required to file an extension when you're getting K-1 reports from limited partnerships. For the most part, I usually talk my clients out of this. They tend to hold on to their master limited partnerships. They've been some of the best performing investments we've got in the portfolios over the years. And part of the reason for that is the very structure of the limited partnership itself. The reason corporations set up limited partnerships is to avoid the double taxation. In a regular corporation, when a corporation makes money, the corporation is taxed on the money it makes. In a limited partnership, the partnership makes money, but the individual partners are taxed on the profit. So in a corporation, when a corporation makes money, it's taxed on the money it makes. Well, now it may have free cash flow that it wants to distribute to its stockholders. So if a corporation distributes that money to the stockholders, well, guess what? Then the stockholders are taxed on it again. In a limited partnership, that double taxation is avoided. So in a corporation, when the money is made, the corporation is taxed on the money. When it's distributed to the stockholders are taxed on their dividend income again. So the government loves corporations that distribute money in the form of dividends because they collect twice. In a limited partnership, when the money's distributed, it's only taxed once. What you tend to see limited partnerships set up in are companies that spin off a lot of free cash flow. You see it in real estate partnerships. You see it a lot. And what I've invested in the past a lot of is the partnerships and master limited partnerships that build and manage pipelines. Pipelines are regulated by FERC if they're interstate. They have long-term contracts. The cash flow is very predictable. As a result, they kick off a lot of free cash flow. And what I've seen is in master limited partnerships, they often spin off more cash flow than they've actually earned in earnings per unit. Now, limited partnerships are not stocks. They're certificates of interest in a partnership. So let's talk about the characteristics of a partnership, at least enough information that you're going to be able to answer the questions that may come up on limited partnerships in the Series 7 examination. When setting up a limited partnerships are chartered by the state. They're not chartered by the federal government. Now, in the case of master limited partnerships, they still have to file SEC documents because they actually trade on the securities market. One of the tenets to an individual investing in any investment is the amount of liability he's taking on himself. If there's the uncertainty of liability, most investors are probably going to say unless they have complete control over the investment, they're not going to take on unlimited liability. Well, a limited partnership allows the limitation of liability to the participation of the individual limited partner. Now, a limited partnership requires at least one general partner that theoretically has unlimited liability. In reality, and you're not going to be asked on this in the Series 7, is corporations who have limited liability are able to act as general partners in limited partnerships. Now, that doesn't make sense because you have a general partner, which may be a corporation, and the very nature of a corporation is it has limited liability, acting as the general partner in a limited partnership. You won't be asked on this, but in reality, there are some very specific rules that allow corporations to act as general partners in a limited liability partnership. So you have two partners. You have the general partner who theoretically has unlimited liability, and you have the limited partners whose liability is limited to the amount of their contribution into the partnership. The general partner in a partnership has management control. The limited partners in a partnership do not have any control. Now, they can do certain things, and we'll talk about that a little later on. But should a limited partner in a partnership decide he wants to control management of the partnership, he takes on the responsibilities of a general partner. Now, quite often you'll see limited partnerships for your clients. Your clients may set up a family limited partnership. And if they're large, wealthy families, there may be some disagreements within the families, and there may be a desire to control the general partner by the limited partners. Warn your clients if they're in this situation that should they decide they want to influence or control management of the partnership, that they may be taking on unlimited liability. They may be deemed to be a general partner should they decide they want to act as management in a partnership when they really are just limited partners in the partnership. The general partner is the one with the unlimited liability. The limited partners, should they decide to try to influence management or manage the partnership, they become general partners, and at that point in time, they have unlimited liability. When a partnership is formed, there will be a partnership document and certificates of the partnership interests, and they may be a general partnership interest or a limited partnership interest. When the partnership is set up, you're going to have certain things in the partnership agreement and in the certificate. In the certificate, it's going to state the name of the partnership, each partner's percentage of the income and loss, when the partnership will be terminated, what the life of the partnership is, and the priority of distributions. So you may have the limited partners getting a certain amount of money before the general partner receives any amount of money, but there's always a 1% interest that the general partner will always have in the profits and losses of the partnership, and that's called the carry interest. And it's called the carry interest because, as a general rule, the general partner doesn't have to pay for his interest, so it's carried on the backs of the limited partners. So when you hear the term carry interest, that means the person that's getting that interest didn't pay for that. And you'll see this term quite often in hedge fund documents. They may have a 20% carry interest on the profits of the partnership in hedge funds. And hedge funds are often set up as partnerships, by the way. or a 20% carry interest on anything over a certain dollar amount or anything over a certain return. For instance, a hedge fund may say, okay, the first 10% is distributed only to the limited partners. The next 10%, there's going to be a 20% carry interest to the general partner, and then the remaining distributed to the limited partners. There are any number of ways that you can write a partnership document and spell out how the proceeds will be distributed. Now, anytime you put together a partnership, it can be amended. And what's required in the amendment is the change in partnership ownership interest during the year. Usually it's done on an annual basis. I know I personally have a family limited partnership. It's been inactive for years. There's no assets in it, but every year I get a document from the state asking me to file an annual report. And basically the annual report is a report of any changes in the ownership of the partnership. So it's required at least annually that you report any changes in ownership in the partnership. You're going to have a partnership agreement, and you're going to have it broken down into the rights of the general partner, the obligations of the general partner, and the rights and obligations of the limited partners. What might be covered in the rights and obligations of the general partner? Well, number one, the general partner is always in a fiduciary responsibility to act in the best interests of the limited partners. He's also in a position where he is not allowed to compete. So he can't go out and set up another business identical to the partnership where he's acting as a general partner in, unless it's spelled out specifically that he's allowed to do that. If it's not spelled out, then he is precluded from competing with the partnership that he's acting as a general partner in. The general partner can decide who's allowed in as limited partners. You don't have to allow in anybody you don't want to. The general partner is the one who has the right to obligate the partnership to contracts. He can enter into contracts, he can borrow money, he can do any number of things unless it's specifically prohibited in the document. So like the general partner can approve who can join the partnership, he can also approve who the transfers of partnership interests are made to. So if one of the limited partners wants to sell his interest to another person, the general partner has a right to say yes or no to the individual that's coming in as the new limited partner. The general partner has a right to his proportionate interest, at least some proportionate interest in the earnings and in any dissolution of the partnership. Usually it's a minimum of 1%, but it can be higher than that. Now let's say the partnership is sued over a dispute. The general partner is not allowed to accept judgment, is not allowed to enter into a settlement on any judgment without the consent of the limited partners. Now, if the limited partners don't agree, then it's going to be appealed. And if there's a final judgment against the partnership, it's going to be paid from the partnership assets. If you have more than one general partner and one of the general partners becomes incapacitated or dies, the law requires that the partnership is dissolved and then reestablished. And again, unless it's specifically spelled out how this would be handled. So if nothing is said in the partnership agreement and the documents, and there's two general partners, if one of the general partners dies, the partnership has to be dissolved and then has to be reestablished again with just the new general partner. It doesn't have to be reestablished again, but it has to be dissolved at that point in time. Now, they can choose to reestablish the partnership or not. All right, so that's the general partner's rights and obligations. What about the limited partners? There's a couple things the limited partners can vote on. They can vote on the admission of a new general partner, and they can vote on the dissolution of the partnership or the sale of the partnership. That's about all they can participate in management. Except now, knowing that that's about all they can do, they do have a right to inspect the books, and they do have a right to their pro rata share of distributions. That's about all a limited partner is allowed to do. If he wants to do more than that, he could be considered a general partner. Just like in a corporation, if there's a dissolution of a partnership, there's usually a priority of distribution of proceeds. Typically, it follows just like a corporation does. The secured creditors get their money first, then the general creditors. But in a partnership, the next one in line are the limited partners and the general partner. How does a partnership differ from a corporation? The IRS is pretty clear on this. The IRS would really rather have corporations where they get the double taxation. So they're looking at partnerships fairly closely to see if, in fact, they can pierce the partnership veil and make it a corporation. Well, there's certain characteristics that a corporation has that a limited partnership should not have. A corporation has an unlimited life. Partnerships, because they want to avoid this characteristics, usually have a stated life, and it could be 10 years, it could be 99 years, but it's not a perpetual life. In corporation documents, usually corporations are set up to be perpetual in nature and with an unlimited life. Of course, they can be shut down and dissolved, but there's no stated end of the corporation. In a partnership, they usually set it up so that there is a specific life of the partnership. Corporations' shares are freely transferable. Partnership interests are not. We've already stated that the general partner has the right to accept or deny partnership interests and to control new partners. Corporations have limited liability. The general partner in a partnership has unlimited liability. Corporations have centralization of management, so do partnerships. The general partner is a centralization of management, so they both share that feature together. Now, the IRS has basically said that they're going to consider a partnership as a corporation unless it does not have all the characteristics or at least 3 of the characteristics of a corporation. So a partnership could have 2 of the characteristics of a corporation, but if it had 3 characteristics of a corporation, it would be considered a corporation by the IRS. So, number 1, let's look at this. Limited liability. Partnerships don't have limited liability, so that one's safe. Now, in the case of free transferability of shares or the transfer of shares in a corporation, as a general rule, partnerships don't have that. But in the master limited partnerships that are traded on the stock exchanges, there is free transferability of shares. And I'm not sure how they get around it, and I haven't looked into it. Obviously, they qualify somehow. Continuity of life, that can be dealt with very easily. Centralization of management, they both have centralization of management. The IRS also requires that the general partner have at least a 1% interest in the partnership, and that can be achieved in a master limited partnership as well. So those are the items you may need to understand on the characteristics of a partnership versus a corporation. Let's talk about how the K-1 reports income and losses to the partners and how the basis of the investment is adjusted by those distributions. Now, when you make a investment in a limited partnership, it can be in cash, it can be by the assumption of recourse notes. In other words, you can say, hey, I'm good for $10,000, and you can call on that money as needed, which is fairly common. You might contribute property that the corporation is allowed to mortgage and get the fair value of that property as your basis for your investment in the partnership. Those are the main ways you might get an interest. It could be also personal property. It could be computer equipment or trucks or something, but it would be based on the value, the fair value of whatever property is contributed into the partnership. So once you've established a basis for your contribution into the partnership, what happens after that? Let's assume you decide to make an investment into a partnership as a limited partner. For illustration purposes, let's go through a couple scenarios. Let's say that you decided to make a $20,000 cash contribution and take on the obligation of another $20,000 in the form of a note. And this is pretty common. This is pretty common to take on a note, to give a note to a partnership as part of your investment in the partnership. And when the note is due, you are required to make sure you pay your note. This is very common. Quite often, partnerships may be specific purpose entities, and the money is not needed all at once. So they stagger the contributions of the partners into the funding of the partnership. As the money's needed, they may make a call, and you're required to come up with your obligations when they make those calls. If you don't, the penalties are usually very severe. So let's say in this case, you made a cash contribution of $20,000, and then you took on a note of another $20,000. So your basis, your investment basis into the partnership is $40,000. All right. Let's say that that represents a 10% interest in the partnership. Your proportionate distribution should amount to 10% of the incomes and 10% of the losses. Well, okay, so let's say that the company made $100,000. Your proportionate interest would be $10,000. So now, this is how it works. You take that $10,000, that's added to your basis, so now your basis is $50,000. And by the way, you're going to be taxed on that, whether it's distributed or not. So you may sometimes in a partnership have income that you've never received any cash flow, and you have to pay the taxes on that income. That's not at all uncommon. So you started out with $20,000 cash, $20,000 note. Your beginning basis was $40,000. The company made your proportionate interest of the income the company made was $10,000. Now your new basis is $50,000. All right. In that scenario, now you have a basis of $50,000. End of story. Let's say the partnership decided to issue a $50,000 dividend. Your proportionate dividend would be, and it's not really a dividend, but let's just say a distribution. It's not a dividend, it's a distribution. So your proportionate distribution would be $5,000. Well, now your basis, because you subtract out your distribution from the Queen's books, so now your basis is $45,000. See how that works? Now let's say you decide to sell your interest to somebody else, and because of the earnings ability of the partnership, you're able to sell your partnership interest for $60,000. You're going to recognize a capital gain of the difference between your basis, which is $45,000, and $60,000. So you're going to recognize a gain, and it may be long-term, it may be short-term, depending on your holding period of your partnership interests. And also, I'm just guessing here, but it's also going to be dependent on the holding of the earnings. So if those are short-term earnings, part of that sale will be short-term gain, and part of that may be long-term gain. Probably the money that was retained, not distributed to you in the most recent year, is going to be considered short-term capital gain, and the remaining may be long-term. That's more than you need to know but just think about it. Logically, if the income retained is not distributed, then a portion of the sales price would be considered short-term gains or losses, depending on if it's sold for a profit or a loss. Now, the new partner that comes in has a basis that he's starting out with of $60,000, and he's going to have to account for his proportionate interest with retained earnings and distributions with a new basis, a different basis than the original partner. Now, the taxing of partnerships can become quite complex. If the partnership has a loss and it's carried on the books at a loss, and a partner sells his interest, his gain or loss is going to be determined by whether those losses were used or unused. And I'm not sure if you really need to know this much, but as a simple example, let's say that a partner had an unused loss in the partnership of $3,000, and he sold his interest in the partnership for $1,000. He would adjust the gain or loss on his interest He would take the $3,000, subtract the $1,000 he received for the sale of his partnership interest to come up with a $2,000 loss on his investment. When a partnership reports a loss on its K-1, the limited partners, or all the partners, are allowed to take their proportionate loss onto their tax return, but they're limited by the amount that the IRS allows to be taken as a loss. And of course, there's carry forwards and carry backs. It gets quite complicated. I don't think you need to know a lot about it, but just understand that it's not like just selling a share of stock. You have to account for the basis in the partnership interest when you're calculating your gain or loss from the sale of a partnership interest. I was looking at a partnership the other day, and they actually distributed more to the partners than they had earned. And where did that money come from? Well, it came from cash flow. And we've talked about cash flow in the past. There's certain expenses that are allowed under accrual accounting rules that are not actually cash expenses. And the biggest one I'm talking about is depreciation. That's in the case of real estate. Now, real estate, you're allowed to depreciate buildings on property, but not the actual real estate. Land is not depreciable. Buildings are depreciable. Buildings are depreciated over a 27-and-a-half-year life. That's a straight-line depreciation method. But in the case of equipment, they have accelerated depreciation methods for equipment. And it's the IRS code which deals with modified accelerated cost recovery system. Basically, different depreciation methods can be allowed to accelerate the loss on equipment. Now, I consider this a true cost of business. Very little equipment ever actually appreciates in value, but there may be a delay between the time you depreciate it and the actual cost of replacing the equipment. But accelerated depreciation, and there's any number of ways to do it. There's sum of the year's digits, there's double declining balance, there's 150% declining balance. You don't need to know those. But just understand that there's ways to accelerate depreciation methods faster than straight line. But buildings on real estate are depreciated at straight line. So anyway, that expense is not a cash expense. And you may see a distribution greater than the earnings of the company to the partners. So that's depreciation is on buildings and equipment. You also have depletion, which is, in the case of an oil well, an engineer calculates the reserves of the oil well. As the oil is brought to the surface and sold, you are allowed a certain depletion allowance. So you actually receive more cash than you're taxed on because of the depletion of the oil well. And that's a true cost as well, because you can only sell the oil once. You can only pump the oil out of the ground once. And that applies to pretty much all natural resources. Ore bodies of whatever ore you're looking at, sand and gravel, oil, natural gas. That's where you hear the term depletion. All right, what type of partnerships are set up? Well, we've already talked about pipeline partnerships. You have oil and gas partnerships. They take advantage of the depletion allowances and avoid the double taxation of corporations. There used to be a bunch of partnerships out there that were research and development partnerships, and they had certain tax credits that they could take advantage of, but I don't think they're around anymore. You do have partnerships that take advantage of tax credits for, let's say, low-income housing or solar farms. Wherever you can see tax credits, remember, a deduction is a deduction from income, where a tax credit is actually a credit on the actual taxes. So if you have a choice between a deduction and a credit, credits are dollar for dollar, and deductions only apply to your proportionate tax rate. All right, let's compare a deduction to a tax credit. Let's assume you made $10,000. You're a limited partner in a partnership, and in a K-1, they send you a K-1 with a loss of $1,000. So that may lower your taxable income, depending on the tax return, to $9,000. So now you're taxed on your income of $9,000 instead of $10,000. And if you're in a 20% tax bracket, your tax is going to be $1,800. Let's take that same example. Say you had income of $10,000, but instead of a deduction of $1,000, you receive a tax credit of $1,000. Well, you're taxed at 20% on your $10,000, so your tax is $2,000. But you got an actual tax credit of $1,000, which is a direct deduction from your tax. So your tax in the situation of a tax credit is $1,000. Quite often you will see partnerships designed to take advantage of tax credits to be able to pass the tax credits on to its partners. And wherever the tax credits are, that's where you're going to see partnerships set up to take advantage of those. All right, there's certain other rules that you probably need to be aware of. Passive income, and most of the time when you're a limited partner, you are taking passive income because you're not actively involved in the management of the corporation. Passive income or passive losses are counted as tax preference items under the alternative minimum tax. So the deductions you get may or may not be applicable to you depending on where you fall with the alternative minimum tax. You don't need to know too much about it, but just remember, the alternative minimum tax may take away a lot of the advantages that you think you might be receiving in a partnership. That's going to finish up the lesson on partnerships. Thanks for listening. All right, let's talk about how customer investment objectives might be met by investing in partnerships. Would partnerships provide preservation of capital? Most likely no. By their very nature, partnerships are not designed to be a safe investment. There is always risk involved in partnerships, even if it's a fairly secure partnership like a real estate investment partnership. Preservation of capital is not the primary objective. The primary objective of partnerships usually is current income or capital growth and appreciation, and to some extent tax advantages. A lot of the tax advantage benefits of partnerships has been eliminated by the various tax reform acts over the years. When I first started in the business, partnerships were one way of taking current income and sheltering it into a partnership and delivering long-term capital gains at the end of the partnership. That's more and more difficult to do now. So I would not classify as partnerships as a tax-advantaged investment. Portfolio diversification, if this is one part of a client's portfolio, partnerships might be part of that diversification plan. Liquidity? No, partnerships do not provide liquidity. It's very difficult to get out of a partnership prior to the liquidation of a partnership. So if you go into a partnership, most partnerships are written as 10-year partnerships, but usually they have an option where they can extend the partnership after 10 years, and most of them do. So you're looking at having your capital locked up to 12 years, 10 years, and then possibly another couple of years after that, up to 12 years. And remember, when partnerships have assets in their portfolio, their liquidity event is selling off those assets. And when they sell off those assets, that's when the cash is distributed to the limited partner. And speculation, would partnerships provide a vehicle for speculation? Well, yes. If it's a hedge fund that's set up as a partnership, that can be part of a speculative portfolio. All right, that's all we're going to discuss on partnerships. Keep studying.